Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: number one, from realestate.co.nz on the 3rd of February, sellers hit 2025 hard with new listings at levels not seen in a decade. Topic number two, from New Zealand Herald on the 4th of February, Housing Minister Chris Bishop reveals Kāinga Ora's turnaround plan to reduce deficit. Topic number three, from Oneroof on the 4th of February, Wellington's average RV drops 24%. Which suburbs are most at risk? Topic number four, from New Zealand Herald on the 5th of February, major banks cut home loan rates. Westpac first to go sub 5%. Topic number five, from RNZ on the 5th of February. Should first home buyers rush to get into the market? So first up for this week in review, from realestate.co.nz on the 3rd of February, sellers hit 2025 hard with new listings at levels not seen in a decade. The rare balance of high stock levels and stable prices, labelled the perfect market in November, is carried into 2025. However, with rising confidence and declining interest rates, many are wondering when the market will shift. After record low new listings in December, January saw a sharp rise, with nearly 9,000 properties hitting the market. That's the highest January level in a decade. Although January typically sees an uptick in listings, this year's surge suggests sellers were eager to start 2025 strong. The biggest increases were in the West Coast, up 100%, Otago, up 52.4%, and Gisborne, up 45.7%. Housing availability in Auckland soared, with stock levels reaching 11,465. That's the highest January figure since 2012. Nationally, stock levels rose 18.9% year on year, totaling 32,412 properties. This increase presents potential opportunities for buyers in the region, with more choices available. For the past 2 years, the national average asking price has fluctuated between $840,000 and $890,000, offering both stability for buyers and predictability for sellers. January's average of $868,969 reflects this trend, with minor shifts across regions. West Coast saw the largest annual price increase, while Coromandel experienced the sharpest decline. While high stock levels suggest an immediate rebound is unlikely, ongoing interest rate reductions could gradually shift market conditions. For now, buyers and sellers can take advantage of a market characterized by choice and stability. It's still very much a buyer's market as opposed to a seller's market, though, with so much choice out there, good opportunities to be found. Topic number two, from the New Zealand Herald on the 4th of February, Housing Minister Chris Bishop reveals Kāinga Ora's turnaround plan to reduce the deficit. Housing Minister Chris Bishop has introduced a turnaround plan for Kāinga Ora, aiming to bring the agency back to its primary role of building and managing social housing. The plan, unveiled in Auckland alongside agency chairman Simon Muta and CEO Matt Crockett, follows an independent review led by Sir Bill English. A key component involves selling approximately 900 older homes each year, with proceeds reinvested into new builds. Bishop emphasised that this would not result in a net loss of state housing, as new construction would balance out the sales. Kāinga Ora, which currently owns about 75,000 properties, is projected to reduce its financial deficits by $190 million this year and $354 million by 2027-2028. Debt is expected to be $1.8 billion lower by 2027-2028 compared to pre-election forecasts. The agency has funding to deliver 2,650 additional homes by 2026, along with 1,500 further social houses through community housing providers starting in June 2025. From 2026-27, Kāinga Ora is expected to handle around 1,900 to 2,000 construction projects annually, including 1,500 new builds and 400 retrofits. 5 key areas of reform: The turnaround plan focuses on 5 main priorities: core mission realignment, prioritising the construction, maintenance and management of social housing while being a supportive but firm landlord; tenant and community management, strengthening oversight and support for tenants while ensuring accountability; housing portfolio and build management, enhancing asset management, simplifying building specifications, and utilising diverse construction delivery methods; organisational performance, reducing overhead costs and improving cost efficiency; and sustainable funding approach, ensuring long-term financial stability through responsible funding and sales strategies. Bishop highlighted that the sale of high-value homes in areas where they're less effective would allow for reinvestment in denser, more affordable developments. He noted that Kāinga Ora owns around 200 houses valued at over $2 million each, primarily in Auckland, which could be better utilised elsewhere. The government is shifting Kāinga Ora's focus away from responsibilities assigned under the previous administration, including infrastructure management and Kiwi Build underwrites. These functions will be transferred to other agencies, and legislative amendments to the Kāinga Ora Homes and Communities Act are planned. Bishop emphasised that past expansion efforts led to inefficiencies, with some newly built homes failing to meet demand. For instance, while nearly half of social housing applicants require one-bedroom homes, only 12% of Kāinga Ora's stock fits this need. The plan aims to realign housing supply with demand more efficiently and effectively. Muta described the initiative as a pivotal moment for the agency, noting that despite delivering 13,000 new homes and refurbishing 3,400 in recent years, some of its growth had been unsustainable. Moving forward, construction activity will stabilise at around 1,900 to 2,000 projects per year, prioritising renewal over expansion. The Green Party criticised the plan, arguing it signals a retreat from expanding public housing and could exacerbate housing inequality. Labour's Kieran McAnulty echoed concerns, stating that maintaining stock levels is insufficient and that the government should focus on increasing supply. Following its 2023 election win, the government ordered a review of Kāinga Ora due to financial concerns, and the findings revealed inefficiencies and an unsustainable financial trajectory, prompting the proposed restructuring. The government now plans to closely monitor the agency's performance as the turnaround strategy is implemented. If you'd like to learn more about the property market in New Zealand and investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor, and these events are available live online. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and would like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Third topic for this week in review from Oneroof on the 4th of February, Wellington's average RV drops 24%. Which suburbs are most at risk? Wellington homeowners are expected to file a wave of objections following the release of new council valuations, according to real estate agents. Quotable Value, QV, published the updated rateable values, the RVs, on Wednesday, and they showed an average 24.4% decline since the last assessment in September 2021. Official notices will be sent to homeowners by Wellington City Council next week. As of September 2024, QV reported the average house value in Wellington at $1.086 million, with land values down 36.7% to $621,000. Some suburbs saw sharper declines than others, with Kelburn Central and Northland experiencing a 29.3% drop, bringing the average RV to $783,429. In contrast, Horokiwi, Makara and Ahariu had the smallest reduction at 12.12%. QV Chief Operating Officer David Nagel attributed the decline to market corrections after the post-COVID property boom. He noted that the market was surging in 2021 due to record low interest rates, but experienced significant drops in 2022 as interest rates rose, lending criteria tightened, and inflation and unemployment increased. Oneroof's analysis found nearly all Wellington suburbs saw declining values between 2021 and 2024. Glenside recorded the smallest decrease at 5%, while Pipitea had the steepest drop at 29%, bringing its average property value from $839,000 to $599,000. Oriental Bay, the city's most expensive suburb, saw the largest monetary decline, with the average values falling by nearly $600,000 to $2.12 million. Despite recent declines, Oneroof data suggests Wellington housing market may be stabilising, with a 2% increase in property values over the past 3 months. However, real estate agents anticipate a surge in valuation disputes. Charles Morley Hall of Just Patterson emphasised that RVs do not reflect market value but serve as a basis for council taxation. He noted that many homeowners already struggling with higher living costs and council expenses may challenge their valuations, especially if their rates remain unchanged, despite property values falling. Bailey's Wellington Regional Manager, Grant Henderson, also expected more objections, stating that homeowners paying rates based on outdated, inflated values have valid concerns. Wellington City Council's Financial Operations Manager, Michael Nyam-Modeza, clarified that a drop in RVs does not guarantee lower rates, as the council's revenue remains unchanged and is simply redistributed among property owners. Velocity senior research analyst Wayne Shum warned that the new valuations, assessed 5 months ago and excluding chattels, may already be outdated. He advised property owners to rely on real-time data, independent valuations, or insights from local real estate agents when making market decisions. Currently, Velocity data places Wellington's average house value at $972,000. Showing minor fluctuations over the past 6 months, sales data indicates that Wellington homes have consistently sold below their RVs throughout 2024. Previous research by Oneroof and Velocity identified the areas most affected by the revised valuations, confirming that the average property value in Wellington has dropped by 20% since September 2021. These adjustments have raised concerns among homeowners about how the new RVs will impact financial planning and property decisions. Topic number 4 from New Zealand Herald on the 5th of February, major banks cut home loan rates, Westpac first to go sub 5%. Westpac is reducing most of its home loan rates, becoming the first major bank to offer a rate below 5%. These rates, which are effective from the 6th of February, its special 3-year fixed home loan rate will drop by 60 basis points to 4.99%, while the standard 3-year rate will decrease to 5.59%. The bank's 1-year home loan rates will fall by 5 basis points to 5.54% special and 6.14% standard. Rates for 18-month, 2-year and 4-year terms will be cut by 5 to 10 basis points, though the 6-month rates remain unchanged after a 20 basis point reduction 3 weeks ago. Additionally, term deposit rates for periods between 5 months and 1 year will decline by 5 to 10 basis points. Westpac New Zealand's General Manager of Product Sustainability and Marketing, Sarah Hearn, noted that this is the first time since August 2022 that the bank has advertised a home loan rate in the 4% range. She acknowledged that customers have varying preferences, with some opting for shorter fixed terms, while others seek long-term certainty. Other banks are also adjusting their rates. Kiwibank is reducing its 2-year fixed special rate from 5.45% to 5.29%, while the standard rate for the same term will drop from 6.35% to 6.19%. Its 3-year fixed rates will also decrease by 10 basis points to 5.59% special and 6.39% standard. ASB, which announced changes on Monday, has lowered its 1-year fixed home loan rate to 5.54% and cut its 2-year fixed rate by 20 basis points to 5.29%. Market expectations suggest the Reserve Bank of New Zealand will reduce the official cash rate, the OCR, at its next meeting in February 19th. In November, the RBNZ lowered the OCR by 50 basis points to 4.25% and signalled another 50 basis points cut in February. Its monetary policy statement projects the OCR will decline to approximately 3% by mid-2025. Last but not least, for this week in review from the RNZ on the 5th of February, should first home buyers rush to get in the market? First home buyers accounted for 26.1% of all property purchases last year, making a record high. While investor activity is expected to increase this year, market conditions remain favourable for those entering the property market, according to CoreLogic. Economist Kelvin Davidson noted that first home buyers were leveraging KiwiSaver, utilising banks' low deposit lending options and purchasing new builds to bypass loan-to-value restrictions. In 2024, they made up 27% of new build buyers. A high number of available properties provided plenty of options, while a softer market contributed to affordability. The median price for first home buyers dropped to $698,000 in 2023 from $719,000 the previous year. Davidson suggested that conditions would continue to favour first home buyers, with mortgage rates likely to decline further and prices still sitting 15 to 20% below their peak. A potential 5% rise in house prices this year was not necessarily a reason to rush, though those with finance approved and a suitable property available might not see a reason to delay either. Investors' market share stood at 21.7% in 2024. That's lower than the 24.5% historical average, with overall property sales projected to increase from 80,000 in 2024 to 90,000 in 2025. Davidson expected all buyer groups to be more active. While first home buyers' market share could decline as investors start to return, they might still purchase more homes than last year. For investors, a drop in mortgage rates from 7% to 5.5% significantly reduced the cash required to service a rental loan. Davidson estimated that on a $780,000 property with a 30% deposit, a 4% gross rental yield, and an interest-only mortgage, weekly cash requirements would fall from $350 top-up to $200 a week top-up, which is still high, just saying, for an investment. While cash flow might still be a challenge for new investors, this shift made entry into the market more accessible, and not all properties are negative cash flow either. Overall, Davidson predicted a balanced market in 2025, offering opportunities for all buyer types. Increased activity from owner-occupiers could also help streamline property sales by freeing up sales chains, which is where one purchase depends on the sale of another one. With major banks cutting interest rates and more changes expected, now's the perfect time to make informed decisions about your property investments. Join us at one of our free events called How to Succeed with Property Investing. These events are available online regularly, and they help you to gain valuable insights and strategies tailored to today's market conditions. Whether you're an experienced investor or a first-time home buyer, just getting started, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving your financial success. In our free events, I'll also tell you about how we help our clients achieve their investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up. If you've already been to one of our free events and would like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website, propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.